Hey guys, and welcome to the Working Money Channel. So Kenwood Capital posted a tweet that was originally tweeted out by Lee Sens here. What do you guys think of my new license plate? Just to show my heart for my two favorite assets, right down here, tagging a few people in this tweet. XRP XLM. Well, guess who decided to troll the tweet thread? David Schwartz. They accidentally put a dot instead of a greater than symbol. So for those of you guys who might not be math enthusiasts, that would be a greater than symbol, which is insinuating David Schwartz means XRP is a greater cryptocurrency, a better cryptocurrency than XLM. Of course, we know David Schwartz, likes to have a little fun, but I always like to say there's a little truth in every joke. Think about that for a second. Anyway, XLM, XRP, both going to be cryptocurrencies that are going to be the future of finance. I've got Bitcoin, though, up right now. It's trading at about $23,100. Marching up slowly but surely, as it has been over the last month and a half, we'll say. So not too much to report there. Just bringing up XRP, you can see up here, XRP trading at about 37.5, just shy of 37.5 cents. So also just following that same trend that we're seeing for Bitcoin. And let's bring up XLM for a second. I haven't taken a look at XLM for a while now. Here's XLM on the chart. We can see kind of struggling to get up past former support here. So marching up, but still not as prominent a trend as we've seen both on the XRP chart and the Bitcoin chart. Nevertheless, still trading at a relatively attractive value, 12 cents, about 0.123. I think we're coming out of this, guys, fairly soon. I think we are going to likely see a pop to the upside. Actually, let's take a look at the total crypto market right now. Total crypto market sitting at about $1.07 trillion, so above $1 trillion. Did come out of this slump testing former resistance from way back here in January of 2021. So we'll see what happens when it gets above this level here. It is trying to combat that level right now. So you can see we're getting a bit of resistance here. That former level of resistance was also former support back in here, okay? We bounced off that back in May. Coincidentally, that is May the 11th, which was a day after the Marin prediction, May 12th, 2 days after the Marin prediction, that tweet that Marin posted over there on her Twitter suggesting that this was going to be the downturn for the market, and then we're going to see a rebound come late October. So a lot of people suggesting Q4 of 2022, this is when we're actually going to see this rebound for cryptocurrency. And so far, so good. The market has been rebounding slightly. Is this going to be a shorter bear market? Like we've seen before in the past, Bitcoin has taken longer to recover in the past. But over the years, those bear market recoveries have become shorter and shorter. And I just recently did a video describing that. So, taking this into consideration, the percentage of time it has taken for Bitcoin to rebound. And if we were to superimpose that structure on today's trend, it's looking like Q4 of 2022, which is what most analysts are saying anyway. And guys, the UK, sounds like we're getting some mixed messages here, okay? So regulators have expressed conflicting messages about whether the UK is a good place for cryptocurrency development to occur. There have been times where I've discussed the UK and crypto development and crypto innovation and how they've been, or how rather some politicians and some aspects of UK government have been very pro-cryptocurrency. Well, the United Kingdom is paving the road for cryptocurrency services, courting startups and establishing players alike, while leading the way in pioneering regulation on stablecoins and non-fungible tokens. So that has been kind of the, initial reaction to this. But a lot has changed after 2 years of deliberations. European Union lawmakers achieved agreements on the markets in crypto asset regulation, marking a pivotal moment for harmonizing supervision of the sector on such a scale. This would follow U.S. President Joe Biden's executive order recommending a whole-of-government approach towards the responsible development of digital assets within the United States. So, is the U.S. influencing the UK now and saying, hey, look, put on the brakes, we've got to be on the same page with regards to cryptocurrency adoption and development? And, is this good for the sector or not? The UK has also seen major political shifts during this period, including the resignation of Treasury Minister John Glenn, whose April speech supporting the industry represented the most emphatic from a UK official to date. While Glenn was broadly supportive of a regulated and nurturing framework for the sector, other UK institutions have voiced concern about the safety and viability of cryptocurrency. So, of course, we're going to see both sides here, debating the merits and debating the shortfalls of cryptocurrency. So are we swinging in the wrong direction now the United States is coming in and influencing UK lawmakers' positions? Ultimately, though, what it boils down to, facing a crunch point in the race for global crypto leadership. The crypto market holds approximately $1 trillion in value. That figure will increase as consumer and commercial adoption grow, creating jobs, improving financial inclusion, and providing fresh alternatives to legacy systems in the financial services sector. So I think at the end of the day, it's going to be a question of, does the West want to be on top? Or are we going to relinquish this over to China and other countries who are obviously developing, their projects built on blockchain DLT technology? Crypto-related infrastructure is being built all around the world. And so, it's all a matter of, we have to get it right in the United States, or this could be a huge blunder. Of course, we've got that little bee in our bonnet, Gary Gensler, trying to create havoc for his own gain. So anyway, this is the latest news coming out of the UK. Despite that, though, guys, Michael Branch is bringing this to our attention. Wells Fargo has said this, okay, digital assets are an innovation on par with the internet, cars, and electricity. So they see the value in cryptocurrency and, this whole new way of doing business, conducting business on the blockchain and with distributed ledger technology. Wells Fargo is the fourth largest bank in the US by market cap, and they just recently released a report entitled Understanding Cryptocurrency, which compares digital assets to the invention of the internet, cars, and electricity. Produced by its global investment strategy team, the report published at the start of August bullishly called digital assets the building blocks of a new internet. Now, guys, let's put this into perspective. This is coming from a bank, Wells Fargo, saying that cryptocurrency is like a new era of technology, similar to the internet back in the 90s. A comment directed to Wells Fargo investment customers stated that the advancement of digital assets will bring new possibilities and investment opportunities. Many expect digital assets to be the building blocks of the new internet, the internet of value. The internet of value is likely to be disruptive to the world of finance, just as the original internet was to communications and information. So they are linking cryptocurrencies to finance, of course, at Wells Fargo, a bank that understands where this is going, that understands the tools that can be leveraged via DLT technology in order to streamline banking a lot better. These guys aren't slouches. They are comparing this to the internet back in the 90s. And so I think it goes without saying that these banks see that the writing's on the wall. We know that there are some holdouts that really don't want to relinquish power, but the legacy system is just not good enough. Especially when the world is becoming more global, commerce is becoming more global, more money is transferring across borders, so enter DLT technology, RippleNet, XRP, and similar cryptocurrencies that are really going to change this. Now, Neil Jacobs posted this, okay? This is a clip from Fox Business. Natalie Brunell here on Fox Business is saying Ethereum is actually a security. I'll let her explain it to you guys.
Ethereum is actually a security, and it should be regulated as such with the proper disclosure of the risks because it's an investment contract. Its decentralization is questionable at best, and we see constant changes to it. There is governance that's involved with the issuance, which is very different from Bitcoin. Bitcoin is a digital commodity. It has no issuer. It has no governance. It has no CEO, no headquarters. And I think that there will be more clarity. I think that Ethereum will eventually be under the SEC, and Bitcoin will continue to be this digital commodity that gives property rights to 8 billion people on this decentralized global settlement network that's available to all but owned by no one.
So, Ethereum, a security, called out by Natalie Brunell here on Fox Business. I think the truth is coming out, guys, slowly but surely. I also wanted to bring this up courtesy of Michael Branch. A new paper highlights some issues with Ethereum. Now, this came out of, I believe it was a university in, where is it? Israel, I think? Yeah. Researchers say they discovered consensus-level attacks on Ethereum, miners cheating the system to earn more. So a research paper was published by the Hebrew University in Israel, and the reports discovered something interesting, the first evidence of a consensus-level attack on a major cryptocurrency. The paper is currently awaiting peer review, but utilizes publicly available on-chain data and Ethereum open-source codebase to affirm its conclusions. What these guys are finding is this, all right? At its core, the paper highlights an issue where miners can change the timestamp related to a mined block to avoid increased difficulty on the network. Hashtag Ethereum hack. Wow. On-chain data appears to support the claims as Aviv Yesh, One of the paper's authors highlighted F2 Pool's blockchain timestamp being artificially altered to improve rewards. So here's the tweet down here from Aviv. By analyzing publicly available on-chain data, we can finally say that the answer to the long-standing question, do miners attack the consensus layer of major cryptocurrencies, is yes. Specifically, F2 Pool's blocks have the fingerprint of the attacked all over them. Whenever F2 Pool's block timestamps reach a point where mining difficulty is supposed to decrease, they artificially set them to be 1 second earlier. F2 Pool has been executing this attack over the past 2 years, and the evidence has been hiding in plain sight. So another reason why we should probably question Ethereum's position in this global financial system and everything that goes along with this. SEC, the SEC's protection of Ethereum, all those people that are connected to the SEC and also have ties to whether it's Consensus or the Ethereum Foundation or what have you, JP Morgan and their motives. It just goes back to this whole thing with the SEC suing Ripple. To me, I feel like at this stage, they probably think that this was one of the biggest mistakes they ever made. They have underestimated the XRP community, and this is backfiring on them big time. So another flaw, another vulnerability, it's looking like on the Ethereum network, the miners are able to change the timestamps. And this is courtesy of some investigators over there in Israel from the Hebrew University. Wanted to thank Michael just for bringing that to our attention. Now, as I've been saying for years, I'm glad Matt Hamilton is also stating this. Ripple exec says XRP was created as a better Bitcoin, and there's a lot to suggest that, considering the timeline when Bitcoin was released, when XRP was initially developed, that there's a lot of evidence to suggest that Bitcoin was a test and that the creators likely had to do something with XRP as well. I mean, I did a video recently where the group of Satoshis, the 4 people that are allegedly supposed to be Satoshi, some of them, actually 3 of them, are connected to XRP. And if you guys didn't catch that video, I will link it up here in the top right-hand corner. And here's Matt Hamilton coming out and saying that the XRP token is still in the top 5 because it works 100% and challenged Bitcoin fanatics to transact Bitcoin on the XRP ledger. Now, you can do that already with the Spend the Bits wallet. The XRP ledger is great for so many reasons. I mean, you can transfer anything of value to anything else of value. And so, I mean, transacting Bitcoin on the XRPL, just one way to be able to transact Bitcoin fast, cheaply, and efficiently. Here's a quote: "If you say so, even by your own admission, it only works 95% of the time. Why do you think the XRP ledger is so popular and XRP is still in the top 5? Because it works. No drama, no big issues that need fixing, it just works. Boring as hell, and that is good." Hamilton, who worked as a principal developer advocate at blockchain firm Ripple, was locked in a debate with a critic arguing that use cases of XRP, the user defended Bitcoin and its layer 2 scaling solution, the Lightning Network, over the XRP ledger. Boy, this guy sounds like he's out of his depth. Another Bitcoin supporter claimed that very few would own XRP due to it being an unregistered security. Yeah, well, I guess you haven't been following the lawsuit as closely as the XRP community has been. If you did, you would know where we stand. So to which Matt Hamilton responded that XRP's use cases are peer-to-peer payments as it was created as a better Bitcoin. So a Bitcoin 2.0, of course, the proof of work system was probably good theoretically on paper at a time. Fast forward over a decade now with Bitcoin in existence, and now we are starting to see the flaws, right? The lack of scalability, the exorbitant prices when the network gets congested, so on and so forth. The critic again stressed that with Bitcoin, money is solved due to the advent of the Lightning Network, which he claimed as decentralized Bitcoin payments with no cost. Hard to improve on that. And Matt Hamilton then highlighted a failed transaction on the Lightning Network over what he said was a lack of inbound liquidity. So I don't have a link to that discussion, but it sounds like Matt Hamilton was very effective at delivering the facts about the XRPL. Of course, as I said before, XRP built as a Bitcoin 2.0. And just the other day, Crypto Annie posted this. This is David Schwartz actually speaking at the NFT conference in New York. This was back from last month. And he even states it here: Bitcoin miner fees are not value, they are a tax.
So proof of work is being used by most blockchains to secure their advancing. It has a very high cost, and as I've said many times, it provides mediocre decentralization. That high cost is not just money, but it's also cost in the in environmental impact and energy consumption. A lot of people have pitched POW as proof of work as providing an equal opportunity, but it just doesn't. It provides an advantage to whoever has the cheapest power and whoever has the best ASICs. And so it doesn't provide the type of decentralization that I think we'd all like to see. I think it's also important to remember that miners pay for power with money generated by the ecosystem. So if you're mining Bitcoin, the money that you use to pay for energy isn't coming from the miners. That money is coming from the people who use the Bitcoin ecosystem. It's a tax. It's a form of residual friction. And I think an analogy to think about is when you look at some blockchains, they measure the value that they're creating by the fees that they take in. So Ethereum takes in a lot of fees. Bitcoin takes in a lot of fees, and that tends to suggest to some people that those blockchains are particularly valuable. But that's residual friction. It's like the money that PayPal makes, right? PayPal reduces friction between buyers and sellers, but the money PayPal makes is the friction they didn't remove. If you're a buyer, any money that PayPal makes is money that you had to pay, and if you're a seller, any money that PayPal makes is money you didn't get. So if you think about fees as being good, they're actually a bad thing. They're a measure of friction still left in the system, and don't think that systems that have more residual friction are better. That's sort of the reverse of a logical way to assess the value of the system.
I thought that was an interesting way to think of the fees. It's like a tax. When there's friction, you need fees in order to alleviate some of that friction. But if you're using the XRPL to transfer whatever it is, a commodity to a fiat to a crypto to gold, or what have you, therein lies the value. The frictionless aspect of it is where the value is, and so they do not have to kind of cover it up with a fee, a tax, as David Schwartz puts. So Ripple's model is to make the most efficient system and then license it to banks. This is how Ripple is making their money, but everybody benefits. Now it's up to the banks, the financial institutions, everybody who is going to leverage RippleNet to discuss what their fees are going to be now when they're basically paying fractions of pennies to perform these transactions. So, if whoever it is, Bank A is saying, okay, we're running on RippleNet, we're still going to charge $10 per transaction, but Bank B says, well, okay, we're also using RippleNet and we're going to undercut you, we're going to charge $7 per transaction. Well, here is where free market will reign supreme. Customers will see, well, I can pay $7 or I can pay $10. Obviously, I'm going to go with Bank B as opposed to Bank A. And now Bank A has to rejig their strategy. So, leaving it up to the end user as opposed to building it into the platform particularly, I think this is the biggest flaw for Bitcoin. Of course, you can transfer Bitcoin still if you still want to hold Bitcoin on the XRP ledger. This is the beauty of it. And I think David Schwartz explains that quite nicely here. Even before the top of the bull market back in 2017 and early 2018, Brad Garlinghouse was also highlighting the benefits of XRP. Ripple is revolutionizing the entire financial infrastructure, guys. This was back from 2017. Brad Garlinghouse on Squawk Alley. It's only 45 seconds long. Here it is.
How big is that problem? How many customers do you have? There's no question there's a lot of hype in this system, and I don't actually think that's a good thing. For Ripple, we use this digital asset called XRP to settle liquidity needs between banks. So today there's $27 trillion parked at different banks around the world so they can make payments between each other. Our view is you can use a digital asset like XRP to do that in real time. Because XRP has been so efficient, it settles a transaction about 3 seconds compared to Bitcoin.
So it just passes through that currency for that period of time.
That's correct.
Yeah.
We got to remember, this was 2017. Brad Garlinghouse still had a lot of educating to do to the people, the banks, the financial institutions that didn't understand it. Fast forward 5 years now, and we are in a very, very different spot. So wanted to thank Nick here, the Crypto Crusader here on Twitter, also Crypto Eddie just for posting that. I also saw this, guys, from DJ Ehudie555 on Twitter. An interesting connection shared with me, thanks R, makes you rethink the validity of the equation used. Here is an interesting connection. BlackRock, okay, hiring a blockchain VP. Also notice the date here, December 24th, 2020, shortly after the Ripple XRP lawsuit was announced by the SEC. I don't know if that is just a coincidence or not, but this is what BlackRock did. Apparently back in 2019, they hired former Ripple executive Robbie Mitchnick to lead its digital assets area. He also penned a paper outlining a methodology for valuing crypto assets. Well, we know BlackRock just got in the game with the Coinbase deal, and back in 2019, they hired Robbie Mitchnick. Now, who is Robbie Mitchnick, you ask, and what is this cryptocurrency valuation model? Guys, here is the fundamental valuation framework for crypto assets. This was a report published back in June of 2018. It was Robert Mitchnick and Susan Athey who published this report. Now, in here, you guys can see a little bit about the author, Susan Athey, economics and technology professor at Stanford Graduate School of Business. She also serves on the board of directors at Ripple Labs and Coin Center, as well as several other technology companies. Her recent research and teaching focus on platforms and marketplaces, machine learning and artificial intelligence, and financial technology and cryptocurrency. Robert Mitchnick, MBA candidate at the Stanford Graduate School of Business. He spent time with Ripple in the summer of 2017. Prior to Stanford, Robbie spent 3 years at CPP Investing Board in public market investments and principal credit investments. He graduated from Queen's University with a BCom and BA in economics. He was the Medal of Commerce winner in the Queen's class of 2013 and stands in the top 1% of the Stanford GSB class of 2018. 2 connections to Ripple, and these guys created a valuation model specifically for XRP. The valuation model, we consider an approach of valuing crypto assets that integrates the 2 primary functions of money, okay, medium of exchange, store of value. We leave aside the use case as a unit of account, which is less relevant. Our hypothesis is that the leading crypto assets today will come to fulfill a hybrid of the medium of exchange and store of value functions, and our model represents an aggregation of these 2 purposes. In order to quantify these 2 functions and capture their translation into price, we examine the supply and demand for crypto assets in each use case. In the analysis that follows, we will denominate all value figures in US dollars. So, let's not forget, this wasn't at the height of the bull run. This was actually prepared and published in June of 2018. So as the market was coming down, after we saw all that hype for crypto back in late 2017, early 2018, back in here, okay, this is again the total market cap for all of cryptocurrencies. They published this back in and around here. So this was as the FOMO was dying off. This is, trying to get people interested in real world utility for cryptocurrencies. Again, their connection with Ripple, a very important factor in this. I think personally, by writing this report, they wanted to kind of detract from, all this excitement and this is what cryptocurrencies are. And they really wanted to kind of focus on the real value where the real price will lie, because let's not forget, at this point in time, so many cryptocurrencies went up, 5, 10, 20, 30,000%. And, people were getting excited. There were naysayers, there were skeptics, and for good reason, of course. But these guys, Athey and Mitchnick, they published this report really kind of hitting this point home that there is a real valuation model. They outline demand, transaction demand here, the storage demand. So I will link this in the description of the video for you guys. The other thing, though, that I think is important to note is that they created this calculator. This calculator is based on the valuation model developed by Susan Athey, board of directors at Ripple, and Robert Mitchnick, Stanford Graduate School of Business. And guys, here is the calculator. Now, I will link this in the description of the video. What I'm going to do is I'm going to take the examples that they give here, okay? I'm not even going to put in outlandish examples. My assumption is this: if they've given examples under each field here, I think that they think that these numbers are reasonable numbers to pop into this calculator in order to get a reasonable assumption of where we could see XRP price one day. So for example, total estimated daily transaction volume, and I mean, we don't know when this is going to happen, but they use the example of 15, so we'll put 15 trillion down in there. Average time in days between transactions per 1 XRP, they've put 0.5 days, so I'll put 0.5 days down in there. Store of value in USD in trillions, okay, they put down 15 trillion, so let me put down 15 trillion down there. Duration at which above volumes are estimated to be reached in years. They've given a 5-year outlook here, so let's just throw in 5 years just to play it safe. Circulating supply of XRP at the above duration. Okay, this is the only one that I'm going to change, okay? Right now it's at 40 billion. We can see down here that the circulating supply of XRP is closer to 50 billion now, 48.3 billion XRP in circulation. So I'm going to put 50 billion, okay? Let me just put 50 billion here. And the interest rate to discount from this duration to present time in percent whole numbers. Example, 5% equals 5, 10% equals 10. So let me just throw in 5 down there. Now, guys, we can calculate a price of XRP based on basically the examples that they've given here for this particular calculator. When I click calculate, guys, we can see their value of XRP based on their examples alone equals about $352.59 USD per XRP. This is a calculation based on the fundamental report that they published here back in June of 2018. Again, the authors of this report, Susan Athey and Robert Mitchnick. Robert Mitchnick coincidentally being hired by BlackRock as their blockchain vice president. And on the heels of this BlackRock Coinbase news, this is seeming more relevant than ever, guys. That's just my opinion, but I want to hear what you guys think. Please subscribe to the channel if you haven't already. Like the video if you like the content I'm providing. I always love hearing your comments. See you in the next one, guys.